Hello and welcome back to another episode of Brighter Retirement Radio. I'm your host, Devin Peterson, and in today's episode, I would love to start a conversation with you about income assets in retirement. Now, at the time of this recording, we're several months into the COVID-19 market decline, and income-producing assets has never been more of an important topic for the minds of folks just like you in retirement. So in today's episode, I brought in a special guest speaker by the name of Marc Rogers, who specializes in research and strategies around income-producing assets. Marc and his firm are research thought leaders in the retirement income industry, and he provides immense insight into the mentality of the current retirees and options to move forward to create some quality income producing assets. So Marc, for the past decade, has had experience in assisting some of the largest, most successful financial advisors in the nation, and has spent most of his career on the education side, educating advisors and consumers about how to reduce risk while still participating in stock market opportunities. And perhaps the most importantly, Marc has brought a message of ensuring income that is both guaranteed and income that cannot be outlived for investors hoping to take risk out of their retirement. So I'm so excited to introduce Marc Rogers in this episode. And without further ado, here's my interview with Marc Rogers. Marc, thank you so much for joining our conversation today. How are you doing?
I'm doing great. Thank you. Thanks for having me on.
So such a pleasure to have you. I'm absolutely looking forward to this conversation. And as we dig into this topic, Marc, I know a little bit about your background and what you bring to the table, and that's what makes me really excited to address some of these questions for you.
Sure.
But really, the heart of what we're going at today is where are Americans at and how can we ensure that we have adequate income as we roll through this post-COVID-19 economic decline, and how they can really enjoy their retirement knowing that their income, more than anything else, their income is there and secure. And so as we kind of take that as the heart of our conversation today, as far as where's the income and how can we really seek to find those quality assets, I would love to just ask you more of a broad question to start.
Sure.
Where are Americans' heads at right now? We, at the time of this recording, we're several months into the COVID-19 market decline. Where are we at? Where should we start looking to really consider how we move forward and put together quality retirement plans?
Well, it's a great question. You take care of your clients every single day. Our firm is a national firm where we deal with investors all across the country. And what's really interesting is pre-pandemic, our firm, and as you know, we do more research and development about Americans and their retirement and what those pitfalls could possibly be through getting through their retirement. And what's interesting is we did a national survey where we surveyed people 55 to 75, and they went through an entire survey about retirement, and we found a lot of fears, a lot of misunderstandings, and a lot of wants of what they are, of what Americans are asking for, but simply don't know how to get there. And so think about this. Pre-pandemic, people have a greater fear of running out of money. That was the number one most feared thing in America, is the fear of running out of money. Number two, in their portfolio, 30% of surveyors said zero is what they can stomach in a loss. This is pre-pandemic, right?
Wow.
So, what I look at today, and of course, there's no crystal ball, and we don't know what this looks like, or certainly how long, of course, this ripple effect of the COVID-19 is going to take, of course. But what we can rely on is the ability to take somebody and put together a plan and really stress test that plan in all different market sequences to make sure that it can last, right? And so I know one of the things that you work on with your investors is to put that income plan together and your process with them. So I think that communication is key, of course, with investors today, because people are worried. I mean, to your question, people are worried and they're misunderstood. They are not being communicated with.
Right.
And most importantly, I don't think that they're being educated enough. I think we as an advisor think, well, they should just know enough to make sure they know that their plan's going to work, but they don't need to know the details. I think in times like these, it's advisors who really get into the weeds with their investors to make sure that they know their plan works.
Right. And so thanks for kind of starting it off that way. I love that you kind of brought it back to the research and said, you know what, before all of this happened, before the market fell out beneath us, people wanted zero risk. People wanted guarantees. People were more conservative. And absolutely today they're thinking that even more, right? And so throughout our conversation today, I would love to keep that as like a foundation and understand and discuss moving forward as we put together income planning assets for clients. How can we really overcome a lot or take advantage of the marketplace or understand where the marketplace is at to make sure that we can create some of those income streams that hopefully reduce a lot of that fear or anxiety, right? And so as we kind of walk into that conversation, I would love to talk a little bit more about where we're at right now. So what are some of the challenges that we're up against, both in the market and interest rates and product options? Like, what are some of the challenges that we face as we move forward to create some income?
Well, there's a lot of moving parts, of course, right, of what's going on. But if I could give you maybe just 3 or 4 major bullet points of what's going on in the marketplace today, and then maybe some solutions to that, I think that'll give us a good flow of content together.
Sounds
right?
Great.
You know, number one, market's been at an all-time high, right? Nobody likes to leave the party when the party's just getting good. And the equity markets, of course, have been on an 11-year bull run. So what history tells us is nearly every 8 to 9 years, there's a major market pullback, okay? More than a 10% decline, nearly every 8 to 9 years. And we've been on this long stretch of positive market, right? 2008, you remember 08? That's when our 401ks turned into the 201k, right? So now we've been in this long stretch, and people have almost forgotten what volatility, you know, what the pains felt like. And now here, fast forward to the beginning of this year, of course, now we're seeing major market volatility, you know, show its ugly head, and we're trying to adjust through that. But the reality of it is nobody, number one, saw that a pandemic was going to be the thing to kind of break up the party, using the analogy, right? But we knew as a major market indicator that the market's been on a bull run longer than ever before, right? So we knew that there was going to be a pullback. We didn't know when, and we certainly didn't know what was going to cause that, right? So that's probably number one. Number two is we follow something called the Shiller price and earnings ratio. Robert Shiller, Yale professor, he came up with the Shiller PE ratio, which is simply an indicator to see, is the market overvalued, undervalued, or priced correctly. Shiller today is saying that the market is at a 30, which there are only 2 other times in market history where Shiller is saying the market's been that high. That's 1929 and the year 2000. So even after this pullback that we've had here in the first quarter of 2020, Shiller's saying that we're still overvalued in our equities market.
Wow.
So now you take number one, long period of stretch. Number two here, our market's more overvalued than before. And then interest rates. Our 10-year treasury today is around 60 basis points. Okay, our 10-year U.S. treasury is at 60 basis points. That's been the lowest since the Civil War days. And really since 1982, we've been on this slow declining interest rate environment. And so as Americans, and they're living longer than any other generation before, which is another major thing here.
Mm-hmm.
But low interest rates are going to majorly impact people because at some point interest rates have to rise, right?
Correct.
And I'm not saying that even it's going to be a sharp increase, but a long stretch of just slow rising interest rates can play a major impact into your bond portfolio. And in our survey that we did with investors, 75% did not realize what happens to bonds when interest rates rise. So rising interest rates can affect your safe money, your bond portfolio. So how do we prepare for that, right? And then I would just say, lastly, the generation of the boomers and all generations behind the boomers is people are living longer. Thank goodness to healthcare advancements, we're living longer. The problem is we're living longer than any other generation before. People don't have pension plans today, changes to Social Security. So all these things are going to significantly impact our retirement income and our plan. Then throw major market volatility, like I said, again, into that whole mix. And we are turning in our stomachs about how we're going to make sure we make our money last, which again goes back to number one fear, most feared thing in America, fear of running out of money.
So as you kind of share those three things with us, I appreciate that, because again, you're kind of, I feel you kind of laying the foundation of this understanding that we live in a very volatile world. Things are changing around us. Low interest rates are really reducing the simple way that we used to save for retirement, which was just rely on our pensions and then put savings in the bank, right? With low interest rate, we can't really do that. So if we're kind of thinking of all the things that you're mentioning in the context of income, how can we produce income with a volatile market or overpriced market? If I hear you correctly, you're essentially saying like we're overpriced. There's going to be a lot more volatility like we've experienced over the last several months of 2020. And it's very damaging to consistently use that volatile account for income, right? But you can't put it in the bank and just rely on high interest rates because interest rates are at an all-time low. You said the 10-year treasury is under 1%, right? And so all of this is really supporting this strong evidence that, or desire that we need to have some asset classes or places to go that create some income that can be reliable, that can be consistent, that can't be outlived.
Correct.
And that's ultimately where we want to go with this conversation, is how we kind of get there, right? So you've done a great job kind of laying the foundation of where we're at. As we start to, because you and your research firm are really thought leaders in moving forward and creating an environment or options for investors that are moving into retirement to create more consistency in their retirement. So what options do we have? What options moving forward are there really for investors in 2020?
Well, I think one piece to understand of looking at options is to also understand the concepts around distributing your money. So let's talk about income, right?
Yeah.
The number one most feared thing in America, we've kind of teed this up. This whole concept of a sustainable withdrawal rate came out many years ago. And today, the research, the data shows that we've tried to base everything around a 4% sustainable withdrawal rate, meaning you take all of your investments at retirement, and let's just say you're 65 today, that if you distributed and took out 4% of your money every year, adjusted with inflation, that would be the proper sustainable withdrawal rate for retirees today. The problem is that the original researcher did two things incorrectly in his research. For one, he used a 60-40 blend, 60 equity, 40 bond for all retirees. And you and I both know that that's not just the same cookie cutter for all retirees today, right?
Mm-hmm.
People have rental income, and they have lots of different types of investments in their bag. So we know that we can't base that, right? Number two with that is he put the same rate of return every year in the equities position, same rate of return every year in the bond position. So no volatility, same rate of return every year. And I don't know, Devin, is there a period of time ever in our history that that's taken place?
Never.
Right.
The opposite of never, right? I mean,
so zero volatility is going to play a major impact here, right? And then the other thing that was broken is no fees. So he assumed that your advisor charged you nothing to manage your portfolio. And again, which you and I both know, and there's lots of different types of advisors out there, that's just sort of unrealistic, right?
Right.
So we teamed up with Dr. Wade Pfau. He's a professor at American College, and his specialty happens to be around sustainable withdrawal rates. And here is what Pfau is saying are the sustainable withdrawal rates for retirees today. Using that same 60-40 blend, okay, he took real returns. So he added real life returns, okay? And of course, he also put in fees. 1.9. 1.9 today still carries a 5% risk of outliving your money.
Wow.
At 1.9. 2.6 sustainable withdrawal rate carries a 20% chance of you running out of money. And 3.44 carries a 50% chance of you outliving your money.
Wow.
50%. What is really scary about that is in our research, we surveyed and asked Americans, what do you think is a sustainable withdrawal rate? And where the vast majority was kind of in that center, right around 4%, there were a significant amount of responders to say 6, 8, and even 10%, Devin, 10%.
Wow.
So what that tells me is, one, there's a disconnect going on of what people think is a realistic distribution rate. Number two, they don't understand market volatility and the impact it can play. What we are experiencing right now for anybody retiring today or getting through their retirement that doesn't have time to make up this now big loss that we've just taken, this is going to alter their retirement. And now people are going to be thinking about, man, should I go back to work again? How can I make up that loss? How can I change around my plan? And I think one of the things that I enjoy in working with Brighter Wealth, of course, and yourself, is you really understand in your process how to create sustainability, how to kind of weather the different storms, because you understand timing risk and sequence of return risk in somebody's portfolio, and you're educating people about retirement and about their income. Right. So, I mean, I'll kind of turn the time over to you and kind of, what are your thoughts? What are your conversations like? And what are you having with your clientele?
Yeah, I appreciate you kind of sharing it that way. My question to you was initially, what are some options moving into and finding income producing assets? And what I like about where you went was really understanding that it's not always about a specific product or a specific, account. It's really how you use that account, right?
Absolutely.
And so with withdrawal rates, I'm glad that you brought that up, because it's not really just about what you're invested in, but it's how you as an investor are using that account. And so you kind of asked about our process and how I think about that. It's really, I genuinely feel that when you're looking for an income producing asset, that's actually the second step. The first step really should be, what are my goals with creating that income, and what are my options, right?
Yeah.
So more of a strategy driven, process driven, not a product driven question in my mind. And so for retirees that are going through this COVID-19 market decline, and they're looking to create, they're scrambling maybe even to create some income, what they really need to consider is where have they incurred losses and where have they not incurred losses, and how can they position their assets to really weather this first storm? Because you're right, when putting together an income plan and looking to create some income assets, you really need to understand where your dollars are coming from, how they're behaving, and then put them in places that support you. And so, in a more direct answer to your question, Mark, when creating some income producing assets, there's several different options. Obviously, we could list a huge list here in this podcast between rental income, annuities, regular stocks and bonds, business interests. You can do a bond ladder, not just a bond portfolio, but a bond ladder. You can create a CD ladder. You can keep everything in cash under your mattress or at the bank. There's lots of different ways that you can use those dollars. But I genuinely believe that the retirement of many of our listeners, parents and grandparents, their environment is different from the one that we have today. And so it requires a little bit of a more strategic, well thought out process of where are your dollars and how are they working for you? And are those dollars doing more than one thing? Is it producing income and also maybe a death benefit if you pass away? Or is it just there for accumulation and not income? There's a lot of things to consider. But kind of bringing it back to our central conversation around income, I believe that putting your assets in a place where they fit your desires for your retirement plan is important. You kind of started this conversation off with some consumer behavior statistics, like not wanting to run out of money, not wanting any risk inside of their portfolio. And what's really hard for investors is to understand that there has to be a little bit of give and take, right?
Yep.
You can't have your cake and to eat it too. And so inside of planning, that's why it's valuable to kind of consider what your overall strategy is and then start putting those pieces in place. As you kind of started off with the conversation about withdrawals from your account, percentage of your account. But as retirees go to increase some of their income, I'd love to talk with you because in a lot of your research, you do discuss different products and different strategies.
Yep.
I was wondering if you can kind of help us talk around some ideas of how to maximize some withdrawal rates inside of a retirement account, maybe using some fixed products.
Great. Yeah. So what's interesting is 1.9 is really scary, right? As that sustainable withdrawal rate. And we can actually use different instruments, different asset classes that can actually create guaranteed income that you never outlive. And you mentioned annuities inside as one asset class amongst other things that create income. One of the investments that we found through our research is that you can actually take a lump sum of money and you can put it into a strategy like an annuity. And that can create one principal guarantee with a reasonable rate of return. So low risk, in fact, no risk to your principal. But then at some point you can flip the switch, and just like a pension plan, just like Social Security, you can create a lifetime income stream that lasts for you and your spouse. And so as an example today, if you're 65 years old, your guaranteed distribution rate that no matter what, even if you outlive what is in your bucket of money, that you're guaranteed a paycheck of 5% for life. And now, there's lots of different types of annuities. There's a lot of noise and confusion, I believe, around annuities. So sitting down with a true fiduciary like yourself where you can get with somebody to go through all the different types that are out there. But in the general rule and sense, one, here's a part of your asset class, and it's a sliver of the pie, right?
Mm-hmm.
That are going to work amongst other different type of investments, some risky, some maybe less liquidity and guaranteed rate of return. Where this lives is a piece of that pie that you just simply don't want to lose. And number two, you need to create that gap between what Social Security is going to give you, right? And how long that's going to plan. If you have a pension, most people today don't actually have a pension plan, but if you're lucky enough to have a pension plan, maybe there's that gap that we didn't need to make up, so we can transition the plan and then create that income, right? Mm-hmm. So if you're getting nearer to that needing an income plan, that type of investment may be a great fit and suitable for you. What's cool is now these type of products are rapidly changing and they're getting better. So now there's strategies where not only can you create that stable income flow every month for yourself, but now these products have the ability to increase every year. So here's kind of an inflation hedge where you have potential increases every single year on an asset that's getting smaller every year. So your bucket of money is getting smaller because now you're taking money out,
right?
And you're getting an increase. These things now have long-term care benefits. If I go into a nursing home or even home health care, and I didn't purchase long-term care insurance, I'm going to self-insure. Here's a way to take my dollar, and as I'm getting my dollars now back out to me and I need help with care, the insurance company will give you $2. So they owed you $1 every month. Now they're going to give you $2 while you're in that facility to help pay for care or at home, right? Mm-hmm. So lots of ways to maximize that. You wouldn't think this is an insurance company or this is an insurance product. It's now should be looked at more of an asset class than a product. And it should be positioned within the plan that can make work for you. And there's lots of different types. And of course, we're not, you and I don't work for an insurance company. So I'm not sitting in the desk of, hey, my insurance company is the best, of course. But just through our research, what our research has taught us is as you age, you've got less time to make up when we have these significant losses like what's going on in our marketplace today. And two, the whole ability to create this distribution, this lifetime income that you can't outlive is really hard to do in other type of investments like a big bucket of EFTs, right?
Right.
You can't stamp that guarantee on there like an insurance company can.
Right. And so for retirees that are looking for more guarantees and possibly really shell-shocked from the recent market decline, what I like about what you're sharing with us is we kind of go back to the numbers with Dr. Fowl, and he's really pointing out or debunking the 4% withdrawal rule, right? And he's saying
absolutely
95% chance that you won't run out of money if you take 1.9% of your portfolio. But creative solutions like an annuity or that type of asset class, you could take up to 5% of your portfolio as a distribution with inflation. And not run out of money. And why? Because at some point you're into the insurance company's pocket. Is that right? It's no longer your dollars, you're into their pocket.
So my grandma just turned 99, right? 99 years old.
Wow.
If your grandma or if you plan to live like that, and what statistics tell us is that if you're married, there's a 50% chance that you or your spouse is going to live to age 90. So my grandfather died in his 80s, right? In kind of early 80s. Uh-huh. So we've had to figure out how grandma's still, and she's so healthy, she's going to go to 120, Devin, right? Wow. So this is where Americans are at. And thank goodness to healthcare advancements. We're living longer, but healthcare costs, those go up, right?
Right.
Taxes, those normally go up. inflation, that normally goes up, right? So the other thing that you need to think about when doing an income plan is not only how I'm going to guarantee my income, but think about my grandmother who retired at 65 and is now 99. And she's had to figure out every year how to give me a birthday present. And I'm one of, 5 kids, and she's got massive amounts of grandkids and great grandkids. And so how is she going to make sure that that money's going to last, right? That's a daunting task. So simplify a piece of it. And when you look at FAO's, data, and what our firm WealthVest has done is really to say there are some instruments that can create that income, and you got to have a story for keeping up with inflation and what's going to happen when you go into a nursing home. And so these are all things that we can plan for today. Mm-hmm. But we got to have those conversations, right? And we got to really think about what that's going to cost you, because you don't want to get to 85 to start planning for what's going to happen at 99.
Right. As I'm kind of smiling as we're having this conversation and you're sharing all of these stats about, 10 years from now, 20 years from now, when you're 85, when you're 99, when you're 120, it is a stark contrast to the many conversations I've had with clients over the last 50 to 60 days, that all those conversations are about their account balance now or yesterday or what's going to look like tomorrow. And there's a lot of worry about these day-to-day fluxes in the market, whether it's going down fast or whether it's coming up fast or slow. The reason why I kind of chuckle is when done appropriately, Mark, and we've really segmented this part of your assets into an asset class that's really just income producing. There's no worry about the day-to-day flux of the market, right? And so it's kind of a cliche comment, but it kind of, this whole peace of mind, financial peace of mind, that's really cliche in our industry. That's really how you come to that place, is where there's a segment of your assets that is unaffected by the day-to-day market swings or market cycles, that is there to be there for you when you turn 85, 95, 125.
Yeah, right.
And that can only be done by thinking and looking and talking long-term with your assets. I think traditionally, when the 4% rule was put into place, investors were in a different mindset. It was their only long-term assets are real estate or just buy and hold into the market. And I don't think that does not have to be the case in our modern financial world and modern economy. There are smart products, there's smart planning strategies out there that can help you really separate those two. Absolutely still have your short-term investments, your knock it out of the park, home run investments as far as some of your growth portfolio, but having your income assets and your safe assets can be a lot more, peace of mind giving than before.
Well, good news is I feel like there's always time to create a plan, right? And I think that I talk to investors like you do, where they'll come up after a workshop that I've taught, instructed at, and it's, Mark, this all seems daunting, right? And how do I implement it? And how do I have a conversation with my advisor that I'm wanting to move on? And I mean, there's just a lot of that where I think people are really worried, right? And because of where we're at, has sort of frozen us. Well, I'm just going to wait till life gets back to normal. What we don't know is, what does that plan look like? And if you haven't implemented it, is there time to create a plan? And I think that the answer is yes, right? Like, sit down with somebody like yourself and have a real conversation about, is it too late? Is it not too late? And if you don't know, because you're nervous. It's like the people that get their statements and they don't even open them up, right? They head right to the file room and they just put them in the file.
Right.
Like, I don't even want to stomach looking at it. Again, wrong thinking. Get to know your statements. How is that going to work? What changes can we make to correct that and stay on the plan, right? So I really appreciate you having me on and doing this. This was really fun because this is something that I think about. I think about my grandma every day as I work with other investors. I think about what these challenges are, and it really is refreshing to work with someone like you, Devin, who has a true fiduciary standard, works in their client's best interests, and is spending time like this, doing this type of education for people, because this is what people need to hear and know to really help them get through these challenging times. So I commend you on what you're doing, and I want to thank you.
Yeah, thank you so much. I appreciate your encouragement for our listeners to really become familiar about their own finances. I'm a firm believer in education and that knowledge is power. And there's a lot of wisdom that can be gathered by seeking to understand even the smallest improvements that you can make inside of your retirement plan. I think those folks that tend to close their eyes and put their statements in their file are really scared because they don't know enough to be confident. And so as folks already have a plan or don't have a plan, revising those plans and seeing how they hold up in today's modern economy, even in a market downturn, can be immensely powerful. So knowledge is power, absolutely. So again, Marc, thanks for joining us here. Before I do let you go, there's one question that I want to ask you, more of a personal note, because I asked this of all of my guests. For you in your personal and professional life, what makes you feel relevant and alive? Your contribution.
Wow, relevant and alive. Well, I'm a huge reader. So I try to just gather knowledge and get lots of perspectives. And what makes me really feel alive is doing things outside of the house, getting up into the mountains, disappearing with my family somewhere, and enjoying the fruits, right? And enjoying that opportunity. We live in an unbelievable country. We're extremely blessed of where we're at. And yeah, just that. I think what's fun for me, honestly, as a traveler who's on the road every single week in a different city, in a different hotel room, my quarantine time during this COVID, although it's unnerving about how long this thing lasts, right? Mm-hmm. Is I've really enjoyed the time waking up in my own bed and being with my little ninjas and that. So that's driving me in a general sense. And I think that this virtual world that we're doing right now is the way of life. So I just will put a plug in, is that I think that investors really need to figure out how to have a relationship with their advisor via this visual, because I think that this is where we're going, and this is going to kind of be where our marketplace maybe is for some time, and that's okay. And this is why we're doing this, right?
It's a great crash course on virtual living. First crash course for sure. All right, Marc, thank you so much for joining us, and thank you for your contribution and wisdom shared today.
Thank you.
Okay, have a great day.